what needs to take place from regulatory bodies and then in concerted better management practices from banks themselves in order for us not to see a larger ranging implication from this crisis that has ensued?
Right. Well, I thought that was a good letter. I didn't agree with all of it, but I agreed with a lot of it. And so I guess, first of all, back to the question about universal deposit insurance, the moral hazard that would create. People say, well, moral hazard, so poorly run banks could attract as much in deposits as they wanted because it's, fully guaranteed by the government. You have a lot of moral hazard. And people say, well, we can compensate for that through supervision, the examination process, the regulatory process. But as we saw, was particularly with Silicon Valley Bank, you can't rely on it. Examiners are good people. They're not perfect. There's some improvements we probably can make to the examination process, but you've got to have market discipline behind it. And you've got to have bank boards and bank management on top of these risks. They're on the front line. And another thing I think that was important for what he said for the larger banks was this all-in outsized focused on these stress tests that the Fed does every year. They're increasingly irrelevant to reality. They haven't even stressed rising interest rates, which is kind of the issue right now. But they do give management a false sense of security. So we're relying too much on supervision. It's not perfect. Stakeholders, managers, boards, as well as uninsured depositors and investors need to take note. They need to wake up and be mindful of risk that are in banking, always in banking, including now in this rising interest rate environment.